How's it going, everyone? Welcome to Investment for Beginner. My name is Andy and thank you for checking out this channel and our second episode. If you enjoyed this video or found it helpful, consider sharing with your friends and family. My goal is to share my knowledge and experience with you so that we can all achieve better financial freedom with plenty of money in retirement, because nobody wants to go back to work after retirement. So stick around and hopefully we all learn something to better our investment. Now in this episode, we're going to talk about stock. I'm sure you heard about stock from news or from your coworkers or from a friend. So what is stock exactly? The stock, to put it simply, is a portion of ownership of a company. If you own a stock, you are part owner of that company. And as a shareholder, and that's what you call when you buy a stock from the company that you bought it from, if the company does well, your stock will increase, therefore creating profit within your stock. However, the company can do bad and the price of stock can fall. But based on the history of the stock market, the stock will always go up, at least little by little, increasing their value. When you invest in stock, it is very wise and safe to diverse your investment into different categories of company. What I mean is that you do not want all your investment in one basket. For example, you don't want all your money in tech company. For example, you want to invest your portfolio in a little bit of tech company, a little bit of retail, a little bit of health service, a little bit in industrial, a little bit of distribution. You want to diverse all your money into different categories of company, because the ideal is that if one of these company or one of these category of company crashes, at least the rest of your investment companies should be fine or safe, so that way you don't lose all your money in process. So that is why you want to make sure you invest in diversity of different company. Just make sure you can manage the portfolio with the amount of diversity you have, because if you have too many, it might be overwhelming or it might be hard for you to manage. So as a beginner, perhaps you want to start with like three different diversity and then increase it to 5 and 10, and just how much you're comfortable with. Because I mean, if you think you can manage 100 different kind of diversity, which I'm not saying there are 100, but if you could diverse that amount, then go ahead and do it. It's your money. You want to try to make much money as you can. Just be smart about it. Now, there are usually two types of people who buys and sells shares. First one is day trader, who buys and sells stocks every day, all the time. So their goal is basically to try and buy the stock when the price is low and sell it high when the price goes up. They tend to make the trade within the day before the stock market closes for the day. The other people, which is gonna be probably majority of the people that's watching this video, buy the stocks and just sit on it for weeks, months, or even a year. When I buy stock, there are a few things the company need to meet on my checklist before I will consider buying them. But once I do purchase the company, I consider keeping them for a month or at least a year, or maybe many years after that, because I see the potential of the company. So if there is a potential of company to grow and make money for me, why sell it? And I will make more future video about what I look into company when I buy stock, so make sure you stick around. When you buy a stock from a company, you want to ask yourself if the company has potential to grow and survive each year. Because it seems like every year there are companies that goes out of business or file bankruptcy. So you want to make sure that the company that you're investing is a company that's gonna grow and survive. Very important, because you don't want to invest in a company that's gonna go bankrupt and loses all your money. So it's very important that the survival of the company is their capability to adapt to the changing world and to obviously make more money. So as a beginner, if you don't know where to start, you should consider looking into a company that is important to our survival or essential to our everyday uses. For example, our world uses energy for basically everything, from making food, from building and running buildings, home, businesses, and pretty much everything. Like even now, I use the light for the energy, I use the camera. Well, I guess you could also use technology because the cameras are made by technology. So you want to make sure you find a company that is essential to our everyday uses, because most likely a company like that is probably not gonna go out of business, because after all, if all of these companies that is essential to our needs and survival, we don't have those, we're probably not gonna be here for that long, or at least not very comfortable, live comfortable life. So as internet is becoming a big part of our life, you might even want to consider a company that makes profit online like Google's and Amazon, because I don't see those two companies going out of business anytime soon or even in the near future. But I personally don't like to invest in social media because it's risky investment for me. But social media is also very popular among society like Facebook, Twitter, and Snapchat. So make sure you do some research before you buy them at your own risk. Also, when you invest in this company, you want to invest in the one that has potential to grow in your lifetime. Don't invest in companies that may not until you're in retirement. I think the best example that I could think of is maybe like space program. They're not that big right now. They are starting to there are talks about space programming and travel to, out of the earth and whatnot, but personally, I don't see myself going big within my lifetime, at least until I reach my retirement. So I'm not investing in any of them right now. But maybe, depending on how the technology breaks through, maybe in 10 years they will go big. So keep your eye on it, maybe. I wouldn't until, I hear a news about it. But then if you hear the news about it by then, maybe it might be too late. Alright, so very important, when you invest in company, you want to make sure the company that you're investing has potential to grow in your lifetime. You don't want to invest in the company that's not gonna grow or take off until your retirement. You can if you want, but just make sure you are doing your math. For me, I like to have companies that's gonna grow within my time and maybe after the retirement too. There might be a company that might do really well within 20 years or 30 years from now. Maybe a company like Space Program. I know they're not that big because we're not going outside the space right now, but we will eventually, and once we do, I'm pretty confident those companies will make a lot of money, because that's what's gonna be our next step in the mankind, I guess. So before we continue, two things you need to know is stock market trading is only available from Monday through Friday from 9:30 in the morning to 4:30 in the afternoon in United States Eastern Time. And stock market trading is usually closed on every holidays. So the first thing you'll learn when looking for stock is each and every company have their own abbreviation, or also known as ticker symbol. For example, Microsoft ticker symbol is MSFT. So what we're gonna do is we usually use the Google search engine, type in the Microsoft, and the first chart they give you a brief summary, but usually what we're gonna do is scroll down and look at the financial Yahoo. So the reason why I use this for this video is because one, Yahoo Financial provide quite a good amount of information. Unless you have your brokerage online account, you're not going to be able to access the amount of information that the Yahoo Financial will provide for you. So this is why I'm using this as an example. So the first thing you'll know is that there's a name of the company, Microsoft Corporation, and their ticker symbol. So when you're on your online brokerage account and you want to type in the, the company that you're searching for, you could type in MSFT or the ticker symbol, or your account should allow a whole company name, the Microsoft. I know my Fidelity, I could either type in Microsoft or MSFT. So below that is the price of the Microsoft stock share. So this is determined by the market cap, which is the value of the company. For for Microsoft, it is over 1 trillion and 148 billion, and you divide the market cap by the number of shares available for the trading, which I believe is in, scroll down, right here. So shares outstanding, $7,700,000,000. So what you have to do is, I mean, not what you have to do, but the way that's calculated is 1,147,000,000,000. Let's see, 1 trillion, billion, million, 100,000. All right, cool. So that's the current price for the Microsoft market cap, and you divided that by the number of share, which was 7,700,000. So, all right, so billion, million, 100,000. All right, awesome. So now press enter, and we got $148.96, which is close to what we see here. I'm assuming that the number of the market cap and the number of share is maybe rounded up or down, so that's why it's very little off. But as you can see, majority of the price for the stock is determined by the market share. I'm sorry, by the market cap divided by the number of share available. So if you find a price different company that has a lot higher than the Microsoft, it's not necessarily mean because they're more valuable than Microsoft. It just means that maybe the number of shares that they have for trading is just lower. We're gonna look at the Amazon real quick. So Amazon is sitting at $1,746, which is significantly like 10 times more than Microsoft. But we're gonna check their outstanding share, which is right here, $500 million, which is nothing compared to 7,700,000,000. Because if we were to take the same market cap from the Microsoft, let me just double check. Trillion, billion, million, 100,000, awesome. Divide that by 495 million. And you get 2,317, which is nowhere the price of Microsoft. So as you can see, the high price of the stock market or the price is not really necessarily better. So don't let the value of the stock dictate your decision. So we're gonna go back to Microsoft. So I know there are a lot of things here. Some of them are probably confusing and don't know what it means. So the first one is the EPS, which stands for earning per share. So EPS shows how much money a company makes for each share of its stock. So higher the number indicate the more money your shares of stock will be worth because investors are willing to pay more for higher profit. So the next one we have is price earning ratio, also known as PE ratio. It's the ratio of a company's shares price to the company's earning per share. So the ratio is basically used for valuing companies and finding out whether they are overvalued or undervalued. Overvalue is when the stock trades at the market price that is significantly higher than their fair values. Undervalue is when a stock sells at a price significantly below what is assumed to be its intrinsic value. intrinsic value is perceived or calculated value of an asset, an investment, or a company. And the last we're going to talk is dividend. Very briefly, dividend is a free money company awards shareholder for owning their stock. So more share you have, the more money the company will give you for each share. Dividend is usually paid quarterly, so every 3 months you'll get a free money from the company. I will make future video dedicated for the dividend, so stick around to make sure how you can make free money from the dividends. So going back to statistic, as you can see, there are a lot more information. We're gonna go over some of these in future video probably, where I'll discuss what I base my decision on when purchasing a stock, and I will also show you my investment account I have on my Fidelity, so you can see what I have been investing and how my investment has grown. So you're probably thinking, how can you make money by investing in stock? So I know I mentioned it briefly in the video, but going back again, you can make money by two ways. The first one is collecting dividend from the company that pays dividend, which is pretty straightforward and simple. The second is selling the stock after price of stock goes up. For example, let's say that you're buying a Microsoft and the price is $100, okay? Just to make the math simple. And you're spending $10,000. That's gonna give you 100 shares of Microsoft. And after X amount of time, if the price of stock goes up to $200, then your 100 shares of stock is worth $20,000. When you sell then you made $10,000. So that's basically how you make money from investing in stock if you want to be buying them low and selling them high, as I mentioned in the earlier video. But you have to also keep in mind that you can lose money. You can lose money if the company does poorly from time after time. So it is very critical you research the company you want to invest and calculate how much risk you're willing to take. So that's it for today's episode. If you sticked around to this end, thank you very much for taking your time watching the video. I appreciate it if you could super smash hit that like button and subscribe for more future video about investment. And lastly, I want to make sure that remember to don't let your emotion dictate your decision. Your feeling doesn't use facts and logic, therefore decision made by your emotion usually result into poor decision.